Dear students, today we are going to discuss last four concepts of accounting, that is full disclosure concept, consistency concept, concept of conservatism, and materiality concept. Full disclosure concept. The principle of full disclosure requires that all material and relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statements and their accompanying footnotes. This is to enable the users to make correct assessment about the profitability and financial soundness of the enterprise and help them to take informed decisions. Full disclosure principle is a concept that requires a business to report all necessary information about their financial statements and other relevant information to any persons who need this information. According to this principle, the management of an entity is required to disclose all the relevant and appropriate information in their financial statements. The financial statements of a business are primarily prepared for the use of stakeholders. Who are the stakeholders of accounting information? Owners and investors, employees, managers, customers, creditors, tax authorities, government, banks and financial institutions, etc. These external and internal users of accounting analyze and interpret financial statements to make informed and detailed decisions. Thus, full disclosure principle of accounting emphasizes that any piece of data that could materially alter the opinion or decision of these users must be included in financial statements. According to the principle of full disclosure, there should be complete and understandable reporting on the financial statements of all significant information relating to the economic affairs of the entity. Disclosure of material information will result in better understanding. For example, the reasons for low turnover. Turnover means sales. Should be disclosed in books of accounts or accounting reports. Next, consistency concept. The accounting information provided by the financial statements would be useful in drawing conclusions regarding the working of an enterprise only when it allows comparisons over a period of time as well as with the working of other enterprises. Thus, both interfirm and intrafirm comparisons are required to be made. This can be possible only when accounting policies and practices followed by enterprises are uniform and are consistent over the period of time. In accounting, consistency requires that a company's financial statements follow the same accounting principles, methods, practices, and procedures from one accounting period to next. That is, the consistency principle states that once you decide on an accounting method or principle to use in your business, you need to stick with and follow this method or principle throughout your accounting periods. In other words, business organizations should not use a certain accounting method one year and a different accounting method the next year. By using a consistent accounting method from one accounting period to the next, the financial reports will hold a similar structure. This makes it easier for bankers, managers, creditors, and other stakeholders to compare the performance of the business over different financial years. All accounting principles and methods should be applied in a similar way from one period to the next so that data reported in financial statements can be compared for one period with that of another period. For example, an investor wants to know the financial performance of an enterprise in the current year as compared to that in the previous year. He may compare this year's net profit with that of the profit in the last year. But if the accounting policies adopted regarding the depreciation in the 2 years are different, the profit figures will not be comparable because the method adopted for valuation of stock in the past 2 years is inconsistent and depreciation is also inconsistent. It is therefore important that the concept of consistency is followed in preparation of financial statements so that the results of two accounting periods are comparable. Consistency eliminates personal bias and helps in achieving results that are comparable.